Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the Bank Reconciliation Statement 1, the first part. Hope you will like, share and subscribe our channel, and do not forget to press the bell icon for latest updates. Bank Reconciliation Statement 1, the first part. Introduction. Bank reconciliation is the process by which the accounts of a business concern compares or matches the balances of its financial accounts with its corresponding information in the bank statement to ensure all money going in and out of the business is reflected accurately in both places. In most cases, a bank reconciliation statement is generated to compare these records and make adjustments wherever required. Goal. The goal of this process is to ascertain the differences between the two and book changes to the accounting records as appropriate. Differences between an entity's books of accounts and the bank's records may arise for mainly three reasons, and they are as follows. First is difference due to timing in recording entries. Second, the transactions being recorded by the bank but not by the account holder. And the third and the most important, errors in recording entries. Sometimes it may be easy to reconcile the difference by looking at the transactions in the bank statement since the last reconciliation and the entity's own accounting records, that is the bank book, to see if some combination of them tally with the difference to be explained. Otherwise, it may be necessary to go through and match each and every transaction in both sets of records since the last reconciliation and identify which transactions remains unmatched. The necessary adjustments should then be made in the bank book or reported to the bank if necessary, or any timing differences recorded to assist with future reconciliations. We will go in detail the common differences between the bank book and the bank statement. Common differences. The common reasons for differences between the balances as per the entity's bank book and the bank statement are as follows. Number 1. Checks issued but not yet presented for payment. Payment is recorded in the bank book immediately on the issue of a check and debited on the date of the payment. However, the bank debits the customer account only when the check is presented for payment. There may be a time gap between the entry in the bank book and the bank statement, therefore difference. Second, checks deposited into bank but not yet credited or cleared. Receipts are recorded in the bank book when the checks are sent to the bank. However, the bank credits the account only when they have been cleared. Therefore, the difference. In interest allowed or credited by the bank. Interest credited by the bank in the account, if any, will be reflected only in the bank statement, which will be known after receiving the bank statement and will be recorded at that time in the bank book. Number 4. Interest and dividends collected by bank. When investments are kept with the bank for safe custody, the income thereon may be collected by the bank directly. This will be recorded in the bank book later upon verification of the bank statement. Number 5. Direct payments into bank by a customer. Amount directly received by the bank from the company's customers will be recorded in the bank book only after analyzing the bank statement. Bills receivable collected by bank on behalf of the customer. The bank collects the proceeds of a bills receivable when the documents of title are sent through it. On collection, the bank will credit the customer's account. The customer may make the entry only on receiving the bank statement at the end of the period. Number 7. Interest and expenses charged by the bank. Interest and expenses charged by the bank for checkbook, demand draft, another city or country check collections, etc., will be recorded in the bank book only after it scrutinizes the bank statement. Number 8. Direct payments by bank. When standing instructions for certain payments, for example, electricity and telephone bills, etc., are given to the bank, the entity may come to know of the actual payment only upon examining the bank statement at the end of the period. Number 9. Dishonor of a bill discounted with the bank. If the bank is not able to receive payment on the bills of exchange discounted by it, it will debit the customer's account together with any charges thereon. The customer will make the entry only when he sees the bank statement. Errors in bank statement or bank book. Errors committed in the bank statement or bank book will be also contributing to differences between the balances shown by the books. Notes. Items 1 and 2 are recorded in the bank book first and later on it's reflected in the bank statement. Items 3 to 9 are recorded first in the bank statement and later recorded in the bank book. Out of these items from 3 to 6 constitute receipts into the bank account, and items 7 to 9 constitutes payments out of the bank account. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share and subscribe our channel Accounts and Finance with FARSK. And please do not forget to hit the bell icon for the latest updates. Coming up next is Bank Reconciliation 2, the second and the final part, and then we will start the cash flow statement, and then we will continue with the IFRS standards. Thank you. Have a great day.